Most people spend more time picking a restaurant than they do picking their mortgage. And that's a problem because the difference between a fixed and variable mortgage can literally make or break your financial plan. And I'm not just talking about a few dollars, I'm talking about tens of thousands of dollars over the life of your loan. Here's the thing, banks don't make their money the way that most people think they do. And if you don't understand how they profit, you are the one that's footing the bill. In today's video, we're breaking down the real difference between fixed and variable rate mortgages, how they actually work, how the banks set them up to make the money, and what that means for you as a buyer in today's market. If you're thinking about buying a home or renewing a mortgage anytime, this could be one of the most important videos that you watch this year. If that all sounds good, let's get into it right now.
You only get one chance to buy or sell your next home. Let's get it right.
Hey, worth mentioning, my name is Darren. I've been helping people just like you buy or sell real estate in the communities of South Surrey, White Rock, Surrey, and the surrounding municipalities since 2007. I started this YouTube channel for the very fact that you're likely watching it to help educate people on everything there is to know about buying real estate, selling real estate, or anything to do with the areas that me and my real estate team service in South Surrey and White Rock. So if you're looking for tailored local advice that will really help you in your particular situation, you can book a time to speak with me and my team in the link below in the description. We'll make sure you understand everything that you need to know so you can make the best decisions when it comes time to a real estate endeavor. Okay, so before we go any further in this video, there's something I really want you to understand about mortgages that most people completely overlook. It's said that roughly 6 out of 10 Canadians will break or terminate their mortgage before the term actually ends. And when that happens, the bank usually wins, and big. You see, most people think that banks make most of their money off interest rates, but that's not where the real profit typically comes from. It's the restrictions, the fine print on the mortgage, and especially the penalties and termination clauses that are buried inside your mortgage contract. So a while back, I filmed a video that explains this better than anything else I've ever done. It's one of the most valuable lessons I've learned in my own personal career and my own life financially, and it's something that every homebuyer should know before they lock into a mortgage. So full disclosure, this is actually a video that I filmed years back when I was new to my journey on YouTube. At that time, it wasn't widely discovered, so I am going to include it in the clip coming up next, where it's going to walk you through the two most important things that you need to understand to choose the right mortgage and avoid getting burned later on. Let's roll that video right now, and I'll see you right after with a few closing thoughts.
This video today is all about the difference between getting a fixed rate mortgage versus a variable rate mortgage. And if you are leaning towards the security and the assurance of what comes along with having a fixed rate mortgage, you want to really consider the two bets that you're making when you decide to go that route. As I just mentioned, many people decide that a fixed rate mortgage is best for them, and the reasons for that are fairly simple. A fixed rate mortgage offers consistency in the payment. There's really no surprises, and it also offers some security against rising interest rates. This all certainly is true, and we're going to get into the first bet that you make when you decide to take a fixed rate mortgage. And that bet is you are banking on the interest rates, or rather the interest payments over the life of your loan, exceeding that of which you could have had if you got a fixed rate mortgage. This means that you are convinced a variable rate mortgage ultimately is going to get more expensive in the long run than the fixed rate product that you might have access to right now. Let's do a little bit of an example. Let's say there is a fixed rate product at 5%, and you can also get a variable rate mortgage for the same term of approximately 5 years for 1% less at 4%. Now, in most cases and historically, the Bank of Canada, whenever they've decided to raise interest rates, they usually do so by about a quarter point each time. And this is for many reasons, but mainly to not shock the economy with monstrous rate hikes. So since we have this 1% spread between the fixed rate and the variable rate, the first bet is that really you're thinking that the interest rates are going to increase by a quarter point at least 4 times, thus matching what the fixed rate available is right now. Or better said, that's 4 increases over the life of your mortgage. So in this example, the variable rate now matches the fixed rate that you could have got. So while this may not feel that great, you've got to remember that over the time that it took for the variable to now match the fixed rate, you've saved some money over the course of that time. Just because the rate is now equal to what the fixed rate was previously, that doesn't mean it's bad. That just means it's equivalent. And again, you've saved money all over this time. So you really haven't lost anything other than maybe the security that it may not go higher. However, let's use the example that the rate continues to move. And let's say it went from 4% to 5%. And let's say it goes even a percent higher, getting increased maybe up to four more times, up to a rate of now 6%, a full 1% higher than where the fixed rate was at the time that you got your mortgage. You need to remember there was a period where you were actually saving money with the variable rate over the fixed rate. And now, with this fictitious example, you are now starting to give some of those savings back because the rate is now exceeding the fixed rate that was available at the time. So the question is, how long does that need to continue until you actually start losing money? So by choosing a fixed rate mortgage over a variable rate mortgage, you're really making a bet that you're going to give back all of the savings that you've acquired over the term of your loan. Definitely something to think about because you have to question how many times in history has that actually happened. The extra seasoning that I want to put onto this is really that a mortgage is typically a 5-year term for most people. So the rate may go above where the fixed rate was, but will it actually stay there or will it return to levels that were below where the fixed rate was initially? Hard to say, but you need to take that all into the account when you are making this first bet. So that leads us to bet number two. And bet number two is that you are not an average person. And if you're like most people, you probably are an average person. What I mean by that is the house always wins, like they say in Las Vegas. And in this example, the banks know that there is a 6 out of 10 chance that you will not see your mortgage through to the full contract term. The banks don't necessarily tell you this, and they want you to break your mortgage because it really pays off in this case for them. So, the big five banks and also many credit unions, what they do is they charge their mortgage penalty to be canceled, and they use something called an interest rate differential. This is a mortgage penalty that is traditionally about 4.5% of the loan amount that you've borrowed. This can amount to thousands and thousands of dollars in penalties if, like 6 out of 10 Canadians, you do not see your mortgage to the end of your 5-year term. Now, you may also think, well, hey, I'm not average. I'm like the 4 out of 10 Canadians who won't break their mortgage. And that very well may be true. But the important thing to remember is that life changes and life can change very, very quickly. You could have family changes like having children. You could have financial changes like a job promotion or a job loss. There could be health challenges that maybe prevent you from working. There could be changes in your relationship and your family dynamics. 5 years is a really long time to think about where you might be and what your life might look like, especially if you're watching this video and you are a younger person who is maybe just starting their career or starting to date and court other people or anything like that. It's a long time, and you need to be very, very careful about committing to something for 5 years when you might not know what the future necessarily looks like. So, we know that the interest rate differential is tied to a fixed rate mortgage. This is where variable mortgages start to become a lot more attractive. Variable mortgages and the penalty attached to them are calculated with a 3-month interest penalty, which is typically significantly less than what you would pay when you do a fixed term loan. In fact, a fixed term loan penalty versus a variable rate mortgage penalty is typically 9 times the amount of what it would be if you had have chosen a variable. So these are the two bets that you are really taking on when you decide to get a fixed rate mortgage. And you've got to really account for, is this the best decision for the next 5 years for you? There is many great studies on this, but one in particular that will be linked below this video where you can see that historically variable rate mortgages have significantly outperformed fixed rate mortgages for years and years and years. So what happens if we find ourselves in an environment where rates are going up at a pace or speed that is a little unprecedented, or it's just generally getting more expensive to have a mortgage? Well, you just need to remember that this isn't forever. A mortgage term is a long time and likely 5 years. So when you get your mortgage and the rates maybe go up, just remember that they can also go down just as easily as they did go up. You're going to want to make sure to ask whatever lender you choose to work with how the penalty on your mortgage is calculated should you need to cancel your mortgage because you want to sell your home or have to sell your home in the future before your term is up. Don't just focus on the rate because this could save you thousands and thousands of dollars and help you be more financially successful in the end.
All right, hopefully that video gave you some real clarity on how fixed and variable rate mortgages actually work, and more importantly, what kind of bet you're really making when you choose one over the other. Now, just to be clear here, I am not a mortgage professional. You should always get specific advice from a qualified mortgage broker or lender who can look at your own personal situation. But the difference here is this. When I share information with you like this, I'm not trying to sell you anything. I'm not trying to sell you a product. I don't work for a bank and I have zero incentive to steer you one way or the other. My only goal is to help you make a smart decision that fits you, not the lender. Because let's be honest, no one who's selling a product is ever going to tell you all of the reasons why another option might be better. That's why getting an independent, neutral opinion from someone who actually sees hundreds of real estate deals like myself can save you from making an expensive mistake. If you want to talk about buying a home or just want help understanding where to start, reach out anytime. And if you found this video helpful, the one coming up next is a must watch. It's the exact presentation we walk our buyers through when they're preparing to purchase their first home. So if you're new to the idea of buying or just want to make sure that you're doing it right, check out that video. It's also the first of a few in a series on our playlist all about buying a home. If that sounds good, that video is coming up next right now.